Welcome to another episode of Daily Market Mastery with me, Christian Rauchenwald. To be precise, we now have episode 11 of this new format. For those of you that are new to this series, quick introduction, heads up, however you want to call it. In this series, I'm using something called Elliott Wave Theory or the Elliott Wave Principle to basically forecast or predict the movements of specific stocks and indices using this magic book here and the one-page cheat sheet. You can read the book online for free. There is a link in the description down below, or you can then use the same link if you want to order a physical copy of the book. And you can also find a link to the one-page cheat sheet down there. As you may have noticed, the stream chat is set, to subscribers only. So while the stream isn't that active right now in terms of reach and live viewership, I want to be ahead of the curve here and basically make sure that only people that actually also subscribe to the channel, and again, that doesn't cost you anything but helps me a lot, are able to interrupt my forecasting and so on with their questions. That said, that's already the reminder. Like, subscribe, enable notifications so you don't miss out future streams, although I do my best to schedule them in advance so you could see them or should be able to see them on the channel page in upcoming streams. Other than that, as usual, the disclaimer applies. So everything that I share in this video / live stream reflects my personal opinion and is in no way financial or professional advice of any kind. You should always do your own research, consult certified professionals, draw your own conclusions, and make your own decisions. Or in other words, just because I decide or because I think that a stock will go up or down and make my decisions based on that does not mean that you have to do the same or come to the same conclusions. It's perfectly fine if you disagree with me and act differently, because at the end of the day, you have to make your own decisions and not just blindly follow me or my decisions, because you also have to take responsibility for the results that you then have. That said, if you don't want to bother with analyzing stocks or something like that at all, and you just want to invest, then you can also consider using a different link that's currently pinned in the chat and also in the description down below to basically just copy my portfolio on eToro, where, as you can see, since inception in May 2020, so 3 years ago, I've been pretty much outperforming the markets on consistent basis, even though 2023 so far is a little bit worse for the beginning, although I'm confident that by the end of the year, we'll also look at a great year back. That said, there's a link for that also in the description down below. Now, if you want to know more about Elliott Wave Theory, you can circle back to episode number 1 of Daily Market Mastery. That is a little bit longer and basically is around 1 hour and goes a little bit into Elliott Wave Theory to give you a very rough understanding. And after that, you should actually read the book, which again, you can do online for free by using the link in the description down below or order a physical copy. For the purpose of this stream, so future episodes and this episode and so on, I try to keep the episodes to around the 30-minute mark, for which, and I'm going to switch there again. For that purpose, I'm actually going to start a timer on my phone right now. So I'll try to focus on one stock or index, whatever the English word is, per episode, and basically, label them according to Elliott Wave Theory, and therefore come to the conclusion if I should either buy that stock, short that stock, or maybe like in our last episode where we looked at, what did we look at? I'm not sure if we still have it open. No, we looked at AMD and came to the conclusion that it could be like this, but it could also be ABC, and we are going further down if I'm not mistaken, And so I think AMD was last week's candidate, So here my conclusion is inconclusive, therefore that's an option as well. And so that screen now you didn't see, but there we go, desktop again. And so summary, we started the stream or the series with Daily Market Mastery episode number 1 and so forth by looking at the SPX, where our prediction is that we're basically now on our way down again, where the current movement here may or may not be the beginning of the downward trend to either confirm our labeling or render parts of it invalid, which wouldn't be a huge reason to worry, at least for me not. And I'm going to hide the message here. And yeah, and then after that, we looked at the NDX. We're in a similar situation, although we don't know exactly where 0.2 right now is. But again, would actually be a perfect turnaround here at the 50% Fibonacci retracement. Then we looked at Shopify, where based on the Elliott Wave Theory analysis, I actually doubled my position from 1.3 to 2.6%, if I'm not mistaken. Let's check that real quick. Portfolio 2.63, yes. And then we looked at Black Knight Inc., and where we came to the same conclusion that it's time to double the position. And we're now also holding 2.6% of that with like a relatively little downside, or yep, that one was 52. So like there was less than 10% downside for us with like a more than 100% upside. Whereas for Shopify, we have like, where we had around 50% downside with a couple 100% upside. And then we looked at Ford, where we are not 100% sure if that plays out like this, or where I wasn't 100% sure if it plays out like this, and as such decided to play it safe in quotes. And we have our stop loss here fairly low, if I'm not mistaken. Nope, yeah, stop loss actually here. So we have here a bigger downside of around 80% or so, or 70%. With again multiple or a couple 100% upside, although here we only have 1.3% of the portfolio invested right now. So even if we suffer the bad option here and actually are wrong, then it's 80% of 1.3%. So overall, it could only affect around 1% of our portfolio. Same goes for the upside. All the upside, again, is like a couple 100% here over the next couple of years. So that's fine. Then we looked at GameStop, the stock that actually got the whole YouTube channel started years ago. And while there are some labels on the chart, I pointed out that since Elliott Wave Theory is based on mass psychology, and therefore, with having 76 million shares or so directly registered and so on, and a huge movement of around, I don't know, 200,000 people that consistently just buy and directly register shares without selling them, the Elliott Wave Theory will simply not apply very well anymore to the stock. It worked very well for most of this. Obviously, for the short squeeze, the waves got way longer. Or for the alleged short squeeze, the waves got way longer than expected, but overall it's still checked out very well. But yeah, so we keep that open. Now we had AMD, where again we are clueless, which therefore means we're actually going to remove that. And I'm going to drag that somewhere randomly just as a reminder for me that here we are clueless. As for the turnaround, so while we had labeling that might suggest that this is our 0.2 and we will turn around, that would align if that labeling here checks out. We are basically actually expecting more to have a turnaround in the 38.2 to 61.8 retracement area, which again would mean another huge drop. So we're talking about wiping out another 70 to 90% of the stock's value before we would see a turnaround. But that would also align with my overall prediction of markets actually going to suffer a lot. So we'll see if that turns out. And for today, we'll have to pick a new stock. So we look at the economic calendar. And the last thing we had was AMD. And we actually want to look a little bit ahead. So April, May, and AMD was here. Ford we already covered. So let's look at Peloton. So PTON next. And for that, we're gonna just open a new chart here and then go to search and look for PTON and open that one up. And there we go. Now, as usual, the first thing I do, since my data source here, and we switch this one here to monthly, my data source is Interactive Broker, which means it might not always provide me with full data. As we can see, we have data from January, September 2019. And the first thing we'll do is we actually open up Peloton also in TradingView and check it out here. And that appears to be right. So the IPO was in 2019, after which the stock had a huge rally up, followed by a massive decline. Now, which brings us to a few Elliott Wave Theory basics that I happily repeat. First of all, when we label something, we are overall always in an impulse pattern. So we are overall always somewhere in a 1, 2, 3, 4, 5 pattern, always, yeah. Now, there are rules to this, like for example, I couldn't say 0, 1, 2, because point 2 cannot be lower than the starting point 1, yeah, which means we would then actually start labeling from here, which would be October 2022, yeah. Now, then there are also things like, if we talk about companies that go public, they very often, probably always, or usually at least existed before they went public, and they went public at the time where the hype around them was the most, so which would indicate a fifth wave movement, because that's when the hype is the most and is about to run out, which is very, very often when we look at individual stocks, again, often and not always, and we look from their IPO, we will see after the IPO they went up and then they went down, yeah, which would indicate that basically, if I delete this, but before the company went public, we had some 1, 2, 3, and then potentially that could have been wave 4 and 5, yeah, or wave 4 could have been somewhere earlier. Again, we don't know because there is no data here, and that would be wave 5, and then this down here would then turn out to A, B, C in some way, yeah. Now, but yeah, anyway, so first point is always check your data sources, because if in other cases, like if we look at the SPX, TradingView provides me with, I don't know, 20 years of history, whereas there is much more of a history, and if I ignore that, I definitely end up with the wrong labeling, yeah. Second of all, when we are looking at a stock since IPO, we will not always be able to label it from the beginning, because in the beginning, from the when does a company go public perspective, one can argue, and I actually had discussions with that with the experts at Elliott Wave International as well, and they agree with me there. One can argue that before the IPO, the company had a value that we don't know, and that they go public around wave 5, and therefore after they go public, we have the finishing of wave 5 and then the corrective wave pattern that's supposed to follow. Yeah, it's like tricky arguing like that, because it may or may not be the case here, but it very often makes sense. Yeah, so, and from another mass psychology perspective, it could be, okay, a new company goes public, investors finally can actually buy the shares and they are positive about it, which means initially a huge demand and the price rallies up, and then either some investors or even insiders want to take some insane profit because their money basically quadrupled or more than quadrupled in value till here, and so they start selling, and then other people start panicking and selling as well. And then obviously in case of Peloton, we also have the actual numbers, so that they're not profitable and whatnot and blah blah blah, that also play into that. But either way, theoretically, we could say, okay, that's the end of a fifth wave, and here we look at a corrective pattern down, which is an interesting aspect because we have two options as said. So we can either label the whole thing from the low here, or we could say, well, that was a fifth wave and we have a corrective pattern down here. And there's going to be like two differences here, because if we say we start from wrong button. If we say we start from here, then we would be looking for 1, 2, because we would look for an impulse wave, yeah. Wherever it goes, and we would add a Fibonacci retracement that just gives us an idea of like how we're doing in terms of wave 2, and that actually it falls into, I'm going to zoom in, and we're actually going to switch here to weekly for now, yeah, and we can see that we turn around the 61.8, a little bit below, which would fit second wave retracement, and second waves are in 40% of cases zigzag patterns, or very likely zigzag patterns, which also A, B, C would work out nicely here. And then also here we would have to have an impulse or a leading diagonal, which in this case works out nice as a leading diagonal. Although I have to say I'm not a fan that very often we end up with a leading diagonal here, although it should only be the rare case. So because if we say this is here, yeah, so it would work out and fulfill the requirements of a leading diagonal. But again, I'm just gonna adjust those things a little bit so I can actually drag them on the right candle. Yeah. If you guys wondering which software I'm using, check the description below. There are links to the tools that we're using here as well. So theoretically, it could work out like this, which would mean that we're actually here looking at our wave 2, and again, like this here would subdivide like again, that point is also wrong. So 1 second. What's the shortcut for the standard tool? Someday I'm going to remember that. S, yeah, makes sense for standard. So the okay, so now that one goes. And there should also be a shortcut for locking stuff or not, or was locking in locking. Okay, never mind. And okay, so that would be 1, 2, and then we could say, okay, our asset that point is actually lower, but something, yeah, no, it actually could be like this, yeah, so that's fine. So we go down here, then we go up there to B, and then we go down to C, yeah. It's not perfect. Probably would look nicer if we do it like this. Angles don't get much better. If we zoom in, we could then try to confirm that. So that would be one option, in which case we would say, hey, let's buy Peloton right now. And we would have our stop loss at the $9 mark pretty exactly. So at the low of this candle, which has a low of $9.09. And our take profit could actually be higher than what we have here. So our take profit would be more than 1783, because we would, if we zoom out a little, at the using Kennedy channeling technique at the so-called base channel, which connects point 0 and point 2 with a parallel line through point 1, extended, and basically a third wave would require then a breakout from here, which means if it happens in a couple of months from now, we would be looking at, I don't know what, no, there's also a crosshair, let's see, horizontal line, is that as a tool, really? Okay, I did not know that, yeah, so if we throw it here, so at like $22, yeah, so we would basically, if we get in now, we would have 100%, more than 100%, because again, we need a breakout from here, not just hitting that line, more than 100% upside with a potential downside of 20% roughly. So that would be our stop loss, because if we go lower than the 9.09, it would actually be invalid. So that would be one option. Yeah. Now I'm gonna learn something new again. How did it work? So open. It's been a while since I did that in Motive Wave. Configure, format, study, no, view. There was an option, or there is an option now, just have to figure it out. Open chart window. Okay, that doesn't bring me anything. Yeah, so I don't need that. There is an option, don't need the volume. Yeah. How does this work? Template, nope. Edit instrument, link, add study, tools. Yeah, so you see, you guys are also group studies, hidden cursor data. That was something I was looking for. So where was that? It was like view cursor data, Alt D. Okay, we'll have to remember that. Snap waypoints. Okay, there is now a shortcut for that, which is also nice. So F5 snaps them, and I've kept, yeah, like, so not what I'm looking for, but group studies, show volume, reset vertical spacing. So auto analyze, we don't need that. Yeah. I'm gonna quickly ask Google Motive Wave alternative charting. Yeah. Yeah, alternative is obviously not gonna help me. Chart multiple variations. Yeah, I'm obviously writing horrible right now. But I get 2 different charts. Okay, that's it. So folder. Yeah, new analysis. That was it. Okay, so if we search, then here we can say manage analysis first. So we have our primary, and now we can say new analysis. Yeah, like downward, and we can say that one is empty, and we go, and with that we get basically 2. Oops. Can I rename that one? Yeah, upwards. So that was our first one, where we say, okay, we start from this low point that we had, and I'm going to switch back to the monthly chart just to make this more clear. So we start from here, and that would be the labeling. And based on that, again, we could open a position and say, okay, the stop loss would be at 9.09, and our take profit would then happen to be, I don't know, like, I mean, there we can add a Fibonacci extension. up, up, up. So we might have one at 161.8 at 32.70, so actually like 200%, or the next one would then be at 87, yeah, so like even much higher. And yeah, so it would be relative little risk with potentially very, very high reward. And that obviously would work very, very well. However, again, if we switch here as well to the monthly chart, we set that based, and we get rid of the volume and cursor indicator, yeah. So we set that based on Elliott Wave Theory and logarithmic chart. Very often this here would represent wave 5, and now this would be the corrective pattern. Now, if we use our cheat sheet and we look at corrective patterns, so again, wave 2 would often be then any corrective pattern, not a triangle, but very often a zigzag. And a zigzag subdivides into an impulse, another corrective pattern, and an impulse, or again, impulse or leading diagonal, any corrective pattern, or impulse or ending diagonal. Yeah. Now, this is important because if we assume that that's the case, well, then this down here clearly is not an A, B, C movement, yeah, because that just doesn't fit the bill in terms of wavelengths, yeah. So I mean, that's one thing to criticize here. And we could try to check if there is a 1, 2, 3, 4, 5 fitting in here, and then if that's another corrective pattern, and if that's a 1, 2, 3, 4, 5. However, this whole pattern down here looks way more as if it's an impulse. So if this is 1, 2, 3, 4, and we're still waiting for wave 5, yeah. So, and if we use Kennedy channeling technique, then we could say, okay, let's drag that over here. So this would be the base channel, and yeah, I can drag that. That's nice. Let's bring it over here. So that would be our base channel with a parallel through point 1, at which point we would have a breakout, which indicates wave 3, which gets us our so-called acceleration channel, for which we have a point 1, and always not point 2, sorry for that, point 1, and always use the high points, which would, for example, be, or in this case, low points, which would be that, with a parallel through 2, which is then indicating when we start wave 4, which would be here. Now we would have our so-called deceleration channel, for which we actually don't need a channel, we just need a line for that, a trend line, because there the bottom doesn't matter. So where we just do like this. So try to connect the dots here and extend it. And basically our wave 4 will continue. Very often it will hit the base channel or the median of the base channel, which means we would go up still. Which means we might actually still look at a trade opportunity either way, which is nice, yeah. Because again, like not always will it hit that channel or that channel, but often or regularly our fourth wave will basically go and hit the base channel or the median of the base channel, and then have the breakout here. So as soon as we have a breakout in this direction here, a confirmed breakout, we actually would be then in our destination channel. Now I need to have a different tool available here to drag that whole thing, yeah. And then let's say this is already wave 4, so we already have our bottom, yeah. Then we would now have a so-called destination channel that we use point 2, point 4, parallel through point 3. Yeah, I'm gonna drag that whole thing a little bit like this, that we extend and can add the median. We would actually expect that our wave 5 then either hits the median or ideally hits the bottom of that channel. I know it's a lot of lines now here, but it would be like this channel here. So we're talking about turning Peloton into a penny stock. Considering their track record and so on, it's not impossible. Yeah, so I mean, we're not or close to a penny stock. So it's not impossible that that's going to happen. But however, like there are two things to consider. So as a reminder, so first of all, Elliott Wave Theory is very, very flexible, which means it could you can look at a chart and you can apply patterns that fulfill the rules that are relatively or slightly different, or in this case, vastly different. So one of the patterns would tell us, hey, we're going up, and go and pre-order your Lambo. And the other one is like, oh yeah, we're just on the first leg of our way down, because that would just be yeah, I cannot select the 5 right now. That would just be the impulse wave that then is only, and it's getting a little bit more complicated, but then only is basically the A of the A, B, yeah, and C we don't even see right now, yeah, drag, yeah, I don't know why it was put up there, yeah, like I cannot even reach it, but yeah, so our C would actually be down there and basically mean bankruptcy for Peloton, yeah, so can I, yeah, snap that, yeah, so that's the contradicting thing here now. We could obviously, so, and it depends on if we say, okay, the company went public around the time when the hype was the biggest, and obviously we also had COVID there, so a lot of demand for the product and whatnot and so on, yeah, because people were stuck at home. But on the other hand, we have our labeling that is like, okay, we start from the most recent low that we can find and try to fit a pattern. Now, the annoying part here is we could, like we did with AMD, we could say, oh, it's not clear, we have to wait for more candles, and based on that, make our decision. So with AMD, we said, okay, it could be A, B, C. It could be that this is already our corrective pattern, although unlikely, and we go up from here, but we're not really confident here because the scenarios are so different, yeah? Now here, however, with Kennedy channeling technique, so we have the labeling from the recent low, where we can say, okay, we have 1, 2, and now we are in the beginning of wave 3, even if first there is some more sideways movements, but after that, we should eventually have a breakout to our wave 3, and with a huge upside. So we're at $11 per share right now, and we would look at basically just for the breakout at least $20 per share and so on. And actually as a profit target, the first one would be at 32.77 roughly, which is again like 200% almost on top. And on the other hand, if we use Kennedy channeling technique, then we would expect, and again, it's not guaranteed, and or like the last thing to drive down here or drive home here with this strategy is that our stop loss would be at $9.09, which means we are looking at like 20% risk, yeah, and we never invest our whole portfolio into one position. So if I invest 1%, we're actually talking about a 0.2% risk to the portfolio with like 2-3% upside. Yeah, if I'm right. So risk reward ratio would be great. And now because we have the contradicting pattern here that would suggest, hey, we have so much more way down to go, we would usually say, screw this, we look for another stock where it's easier and where we have a clearer picture that where everything we can come up with points upwards, yeah? However, using Kennedy channeling technique, we can also, as said, say that, again, very often, I mean, there are multiple things. First, rule of alternation. If we have a short and simple corrective pattern in wave 2, then we have a more complicated and drawn out pattern in wave 4. Now, that would already be fulfilled here, but it could mean more drawn out. Second of all, Kennedy channeling technique, not always, but often will we anyway have our cursor, will the fourth wave touch the top or the median of that base channel? And if you look here on the left in the cursor data, I'm going to drag it up there again. So that median here would be anywhere between 17 or 18 to 22. And if it would happen earlier, we're talking like close to 30. Yeah. And if we then consider the whole reason why we picked the stock Peloton to look at, which has their earnings in roughly a month from now, it's basically possible that the earnings are either the reason so that people buy until the earnings because they are expecting good results, and then maybe their earnings are horrible and a huge sell-off happens. Yeah, so that's how we get to have like then wave 4 to be here and then wave 5 to be further down. It's also possible that, again, now we already have the small anticipation and then we have great earnings, which trigger that third wave, so the breakout here. But the important part here is that either way, here our stop loss, if we go with this labeling, would be around 6.66. So that's where, yeah, no, actually it would be, yeah, it would not even be a stop loss, but the stop loss is basically our median here if we were to sell it short. So our stop loss actually still comes from this labeling here where we have, changed something by accident. So where we would have our stop loss at this point too at $9.09, whereas our take profit would be around 22. So again, we have 100% upside with a 20% downside. So buying 1% of the portfolio, that then means we actually have 1% upside for the portfolio or a 0.2% downside. And I actually like those odds. So although we have conflicting patterns here, considering that Kennedy channeling technique here would actually suggest that we might get like, I don't know, like 22, 20. So I'm gonna buy that, and I'm gonna risk 1% of the portfolio on it. So the position size is 1%. The actual risk is obviously lower, and I'm gonna buy it, and yeah, so 1%, so around 1%, so it's never exact. Yeah, so PTON invest. So we're gonna say with this, and our stop loss was at, as we said, as 909, which makes it a 20.19% risk, and our take profit. So our definite take profit here, it's hard to determine, to be honest. Yeah. Yeah, hard to select the wave 4 here. So technically we could go somewhere around the 22 mark. But then in case this turns out to be the right labeling, we would actually suddenly sell when the biggest upwards pressure starts to hit. So I'm actually not going to set a take profit on this one, because we anyway have the labeling for it open. And during our daily streams, we quickly recap. We're going to close the AMW labeling since we anyway discarded that. Yeah. And we're going to keep this open. And I will, during the streams, basically see how it goes. Because if we have good earnings, and actually then, yeah, so like actually that one here would turn out to be the accurate labeling, then we definitely want to go and see the 161% extension and the bigger profit, and not already close early at 20 something. So we probably would then use a trailing stop loss or so. And well, if we are wrong and we hit our stop loss, then we anyway have a small downside here. So yeah, we're gonna go with open trade now. And yeah, now let's check here. So if I refresh the portfolio, we should now see the position with 1.31%. And yeah, as said, so I like the risk reward here. And again, like, it's a perfect example that Elliott Wave Theory can have, or at any given time, multiple patterns apply. And it then comes actually down to the guidelines. So we could look closer and confirm each wave on lower time frames, and then look which of the patterns fulfills most of the guidelines as well. But that applies also more if we pick the same starting point. So we could also, if we look closer and we label from this starting point, it's possible that we also fit different patterns in here, and that we then, based on that, have then to use the guidelines. However, since we pick two totally different approaches here, one, we start from the most recent, really loaded, or not most recent, but from the low point that we can find. And the other one, we consider the IPO as an ended fifth, or the ending of a fifth wave. Yeah, makes the guidelines a little bit irrelevant. But again, I like the odds. So risk reward ratio is okay now. And we haven't invested a lot, which makes it, yeah, a decent gamble. Hi, Akashi, great to have you here. Just about to finish up. Yeah, so yeah, and we'll see how it turns out. So make sure, if you haven't subscribed already, subscribe, join in for future episodes, and you can then see how this develops. And we'll see if it pays off, or if this is one of the cases where I'm simply wrong. Yeah, nobody's right 100% of the time. But yeah, so with that, actually circling back here, so I said streams 30 minutes. We're a little bit above it, but not much. So, and we managed to label Peloton in this episode of Daily Market Mastery with two interesting potential options, but still a decent risk-reward ratio to actually open a long position. And yeah, not sure what we will look at tomorrow. The future streams are already scheduled. For those of you that are not only into trading and investing, my streams on Twitch for this week, so my casual evening gaming and small talk streams are also already scheduled. And on my main YouTube channel, the streams that I have about crypto, passive income, and stuff like that are also already scheduled. You can find links to most of them in the description or on the channel page and so on. Yeah, Akashi said, so like welcome, and actually in that case, bye-bye already, because I'm summing it up. or finishing it up, wrapping it up, that's the right word. And yeah, like there will be a stream later on Twitch for you as well. So we're going to continue Quantum Break. So I guess I see you there, Akashi. And everyone else, again, see you either in another episode of Daily Market Master.